You think you make logical decisions with your money. The data suggests otherwise. Let's run the numbers. Here's a puzzle. Two mutual funds with identical holdings and identical risk. One is described as a value fund focusing on dividend income. The other is described as a balance fund with steady appreciation potential. They're actually the same fund, different framing, yet investors perceive them as different investments and make different choices. This is framing. How you describe something changes how people evaluate it. Tversky and Kahneman demonstrated this with the famous Asian disease problem in 1981. The setup: an outbreak threatens to kill 600 people. Two treatment programs are available. Program A is described in terms of lives saved. If Program A is adopted, 200 people will be saved. When faced with this positive frame, most subjects choose Program A, the safe choice. They're risk-averse when facing gains. They prefer certainty. But here's the framing twist. The same programs can be described in terms of lives lost. Program A: if Program A is adopted, 400 people will die. That's the same program, but loss framed. When faced with the loss frame, most subjects reject Program A. They choose the risky alternative instead. Identical programs, opposite choices. The only difference is the frame. The mechanism: in the gain frame, people are risk-averse. In the loss frame, people are risk-seeking. Same objective choice, different risk preferences depending on frame. This finding, called the reflection effect, is a core part of prospect theory. Levin, Schneider, and Gaith, 1998, identified three distinct types of framing effects. Type 1. Risky choice framing. How you present probability and valence affects risk preference. People respond differently to 90% success versus 10% failure, even though they're mathematically identical. Type 2. Attribute framing. How you describe an object's characteristics affects its evaluation. Ground beef labeled 75% lean sells better than identical beef labeled 25% fat. Same product, different frame, different choice. Type 3. Goal framing. How you frame the persuasive message affects persuasiveness. Each type operates through different mechanisms, but all three show framing changes choice. Application to finance. Barberis, Huang, and Santos, 2001, modeled how framing affects asset pricing. If investors derive utility from fluctuations in their portfolio value and are loss-averse over those fluctuations, framing of gains/losses affects their willingness to take risk. This framework can explain asset return patterns. How you frame a stock as up 10% this month versus the long-term return affects how much risk people will take. Here's the problem. Institutions know this. They use framing to influence investment choices. A bond fund is marketed as 98% probability of meeting your retirement goal, not 2% chance of shortfall. Same probability, different frame, different choice. A hedge fund is marketed as 8% annualized return, 12% volatility, appealing to risk seekers, not losing 1 out of every 5 months, unappealing to loss-averse people. The boundary. Framing is not lying. The facts are accurate in both frames. The information is truthful. But framing is selective. It emphasizes certain aspects while de-emphasizing others. The resolution: knowing about framing effects doesn't fully protect you from them. Framing effects operate automatically. Knowing about them helps, but you'll still respond to frames. Strategy 1. Demand alternative frames. When evaluating an investment, ask for the downside framing. If someone says this fund has a 95% success rate, ask what's the failure rate. Force them to provide the loss frame. Strategy 2. Look at the actual historical experience, not the statistical frame. How often did this fund actually lose money? In which years? How large were the losses? Show me the actual drawdowns. Strategy 3. Use the long-term frame for your own decision-making. When evaluating your own portfolio, use long-time horizons. Over 20+ years, stock market returns have been consistently positive. Negative outcomes become rare. This long frame prevents loss aversion from triggering. Losses feel less real when they're temporary noise on a 20-year uptrend. Strategy 4. Standardize your investment information gathering. Use consistent frames for yourself. Always look at your annual returns, never monthly returns. Always look at 5+ year performance, never 1-year performance. The application: framing is inescapable, but you can control which frame you use for your decisions. The implication: be skeptical of institutional framing. Look for the de-emphasized facts. When a fund describes itself as designed for long-term growth, ask, how frequently did you lose money? What were the worst years? Look at objective historical data, not the frame the institution provides. The frame is chosen strategically. Application: When comparing investments, force yourself to frame them identically. Compare all funds using the same time frame. Compare all bonds using the same risk metrics. Don't let marketing-friendly frames distort your comparison. Strategy 5. Build decision rules that reduce frame dependence. Automate as much as you can. If your rule is 60-40 allocation rebalance quarterly, that rule is frame independent. Quarterly rebalancing happens regardless of how the market is framed in the news. The resolution, framing effects are one of the most pervasive decision biases, but they're also one of the most manageable. Because the solution is not to resist framing, you can't. The solution is to standardize your frames. Use the long-term frame, use the downside risk frame, use the historical reality frame. Make those your default frames. Apply them consistently. This neutralizes framing's power to distort your choices. Your 60-40 portfolio gains 8% this quarter. Don't celebrate the frame 8% gain. Instead, use the annual frame. You're on track for your year-end goal. Your portfolio loses 8% in a market correction. Don't panic frame it as a crash. Instead, we're on a sale, time to rebalance and pick up cheap assets at lower prices. Frame control is portfolio control. The frame you choose determines how you'll respond to market movements. Choose your frame intentionally. The institutions will choose theirs. But your frame is yours to control. The implication: build a long-term frame explicitly. Write it down. Use it consistently. Example: I'm building a diversified portfolio for 20-year wealth accumulation. Annual performance doesn't matter. Quarterly losses are opportunities to rebalance. I frame all decisions using 5-year or longer horizons. Don't fight your brain. Engineer your environment. See you next time.